What's poppin'? The smolder boulder, baby. Here we go. What is up, everybody? Over the trades, we have technical analysis on different stocks in the stock market, as well as potential buy, hold, or sell opinions on these given stocks. I might have to consider revising my intro because I do a lot more than technical analysis these days, but whatever. I'd like to preface by saying that I'm not a financial advisor nor expert, so take what I say with a grain of salt. Let's get into the video. So today, we're going to be talking about AMC liquidity. Now, this is a kind of broad overview on a couple different topics that I think are going to play into not just AMC, but the market as a whole. I think you're going to be seeing a pretty, I should say, volatile market over the next 2, 3, 4 weeks. And this is obviously just a prediction. I obviously can't read into the future, but it's hard to overlook some of the things that are happening on the side with, the Federal Reserve, the Feds, as we call them, bond yields, different margin calls, the SLR, which is, supplemental leveraging ratio. Very interesting stuff going on here. So we're going to look into how this will affect the market as a whole, how this may affect AMC, and just dig into the video as we always do. So I had to drop a freaking gorilla as per usual, guys. We've got this isn't Kong by any means, but just a good old silverback gorilla down on his four hands and feet, doing what gorillas do, straight up Jay chillin'. So anyways, let's get into the video. So I want to start off here with an example, right? So we're gonna start off here talking about Discovery crash, and I've got every single article pulled up here that I'm referencing for the purpose of this video, and we're going to come back to these to reference them as we go along. I want to give credit where credit is due, and a lot of this research was helped by a member of the Discord. So props to that guy from over the Discord. I do appreciate you immensely for helping to put together this awesome video. And his name is Uranium Potato YT. So thank you to my brother. I appreciate that immensely. So we're gonna start off here with Discovery crash. It had a 35% drop, and this is talking about Discovery directly, but there are two stocks that got affected by this crash. So you've got shares of Viacom, CBS, and Discovery falling as much as 35% Friday. And I've done the liberty of pulling up this stock for you. So if you look at this on a 6-month chart, we've got Viacom CBS Incorporated pulled up here on the chart. It had some great steady growth all the way up to $101.97. Now, if you were to look at this chart and think to yourself, why the heck do we have this drop? This doesn't seem warranted at all. There must have been a terrible hit piece that came out. And let's just look at the news that we have here. Viacom CBS Discovery plunged due in part to forced liquidation of Archegos capital positions, right? So not even a bad hit piece came out on this. It was just pure liquidation, which we're going to get into here in a second. But this is a nasty sell-off, and I think a precursor to what could be happening in the market at a later date. So coming back to my whiteboard, what we have here is Tiger Asia LLC as the primary cause of this major sell-off. Now, what's the issue with these guys, right? Well, Tiger Asia LLC, they are very infamously known for leveraging positions. Now, we don't know if that's leveraging long, leveraging short. They can do it both ways, but essentially what leveraging is, I've drawn this out as a question right here in case you were wondering, is if you have, let's just say $10,000 of cash and you have a 2-to-1 leverage, that means that you can trade with $20,000, right? You can do this both long and short depending on the sort of brokerage account that you've got set up. Obviously, these big institutional investors have some more rights to liquidity than the average retail investor who may not be playing with as much money. For them, that could be $10 million to $20 million, right? So essentially what happened is you've got Tiger Asia LLC who gets margin called, right? So if we were just to read through this real quick, a liquidation of holdings at several major investment banks with ties to Tiger Club, Archegos Capital Management LLC contributed to an unseen daily decline Friday in shares of stock, including Discovery and Viacom CBS Incorporated. Shares of media conglomerate Viacom fell 26%, while Discovery dropped 27%. The common thread is this: defunct Tiger Asia Management LLC founder Bill Huang, who now runs Archegos Capital. His fund was and may still be a large owner of shares in both Viacom, CBS, and Discovery. He did not respond to phone calls, emails, or Bloomberg messages sent by IPO Hedge. These phone calls essentially being margin calls, right? So one person familiar with the matter said Mr. Huang's fund received a margin call from one of the investment banks, not necessarily Morgan Stanley or Goldman Sachs, but regardless was unable to meet it, and as a result, that bank and others began to liquidate stocks owned by Archegos. So that is why you saw this massive sell-off that happened in VIAC, right? Viacom CBS Incorporated. Now, why is this important? Why am I bringing this up, right? So if we come back to this, the leveraging piece, right? So this is going to tie into what I want to talk about here more so as we go on in the video. Leveraging, or playing with more money than you have, playing on bank money, borrowing money with an interest fee, right, an annualized interest rate, can lead to a margin call, or or, two situations. So what is a margin call? They call you. You essentially get a call, an email, all those things that ended up happening to, Tiger Asia LLC, Management LLC. And they say, hey, you've got two choices here. You either A, put more liquidity in your account, or B, liquidate your own stocks to meet that liquidity issue, or we're going to liquidate some stocks for you to get the money that we know we owe. You owe us. Now, typically you don't get a margin call unless you are short on a position. So if I had to take a stab at it, right, they went short on a position, which means that you have an infinite amount of losses, and those can accrue very, very fast. Now, you can't get a margin call playing long, right? If you buy in a stock at $10 and you're leveraged, and, let's say you're a 3-to-1 leverage playing with, $10,000. Well, all of a sudden, if this drops down to $6 and you're playing on $10,000 on a 3-to-1 leverage, that means you're playing with $30,000. You would have accrued losses on $30,000, which could in turn, put you net negative for the actual money that you had in your account, the cash, the settled cash in your account. So it can happen with long positions, but regardless, it affects short positions, I would say even more so than long positions, because you do have that infinite upside for loss, right? So you can get a margin call and they say, hey, you either pay up or we liquidate your account, which is what happened to Tiger Asia LLC and led to this massive sell-off that we saw with Viacom CBS Incorporated. Now, we're going to talk about this block trades with Goldman Sachs, right? This is another big piece of the puzzle to talk about, as they had a huge amount of liquidation that took place. Goldman sold $10.5 billion of stocks in block trade spree. Now, what is a block trade? This is essentially, this question right here. It's a large trade that takes place between two parties of either equities or bonds. Equities can include securities such as stocks, right? And I think this did take place, obviously, in the market, as you can see by this article. This was posted on March 27th, which was today at 1:24 p.m., right? So if we're going to take a quick little glance over this, Goldman Sachs Group Incorporated liquidated $10.5 billion worth of stocks in block trades on Friday, part of an extraordinary spree of selling that erased $35 billion from the values of bellwether stocks ranging from Chinese technology giants to U.S. media conglomerates. And essentially what this is this liquidation, these huge block trades took place from big banks such as Goldman Sachs, right? And they closed out positions of mega hedge funds who may have been long or may have been short, leveraging, and needed to pay up. Now, this is some pretty weird timing. This is some strange timing, and I'll tell you why. Because we know, and I'm going to get into this later in the video, that this SLR may possibly be expiring on March 31st, which is this next week, right? And that's massive. That could really play into the hands of what is happening here right now. And, we're digging into the weeds. This is just a prediction. This is nothing that's set in stone. They may end up extending it, but Jerome Powell, who works for the Feds, the Federal Reserve, right, has not stated anything about this yet. So I'm very fascinated to see what ends up happening. But regardless, that's a big piece of the puzzle. So you've got Goldman Sachs, who has liquidated $10.5 billion, saying, hey, we're covering our butts. We don't know if you're going to be able to pay up, so we're just going to make sure we get our cash. And you take care of your trades and make sure you're not screwing us, right? So they liquidated. And this may increase day by day as we get closer, and especially if we get hard news stating, hey, the Feds are not approving this continuation of the SLR or the leveraging ratio, essentially, the supplementary leveraging ratio. So now that we've dug into sort of the basic rundown of what's happening here with Discovery, why this happened, you had those liquidity issues. They had Tiger Asia LLC that was leveraging, play with more money than they had. They got margin called, couldn't match. They had to liquidate accounts. This happened to crash Viacom CBS's stock price, right? Now let's dig into this more and how this could affect the market and how this could affect AMC. So when you close out or liquidate positions, right, there's a couple different ways you can play this out. They may end up liquidating your short position, your long position, as well as other positions to make sure they get their liquidity, right? It depends on the situation, how much you're down, how much you owe, et cetera, et cetera, et cetera. But this can play into AMC and their stock price. So we're going to start off here by talking about the Feds, the Federal Reserve. So they have leverage ratio exemptions that are in place right now. Now, what is essentially this saying? Well, this ties into that SLR, the supplementary leverage ratio. Now, this sort of got written into, legislation with good intentions, right? This was an opportunity for banks, big banks, who may be suffering, losses of liquidity based on what happened with COVID, what happened with quarantine, all the way from March to now, right? We're starting to see some equalization go on in the market. There's less uncertainty. We're working towards, reopening. So that may be why we see this happening. My hypothesis, though, is different than that. So I think that the supplementary leverage ratio had good intentions, right? Good intentions initially, but was abused, as is typical of the market. When you give people power, they will abuse that power. I have nothing, no gripe with Tom Brady, but here's an example, right? So the NFL, they make rules all the time saying, hey, this is how it has to be. And you find people and teams who will find ways around those rules. I don't even know why I brought up Tom Brady, but here's a good example. So they changed the ruling of an onside kick, right? Onside kick, you had to, they changed the distance on an onside kick. Well, there are people out there who found ways to essentially kick the ball in a different way where it spins sideways so they have a better chance of recovering that onside kick, because as it sits now, it's nearly impossible. The success percentage of recovering onside kicks has gone down dramatically. Well, because of those new rulings, you've got teams out there who are finding new ways to go about those rulings and find new ways to recover onside kicks, right? So with this supplementary leverage ratio, they laid out the rules, right? And they said, hey, these are the rules. Whoa, that was a weird W. That was not a George W. That was just a weird W. These are the rules, right? And you just have to stick within them. And you got big banks out there thinking, okay, based on these rules, I know that I can leverage probably more than I should, right? And we can lend out, money more so than maybe we were able to in the past. Maybe you've got hedge funds out there that are able to over leverage, right? There's different ways that this can be played out. And this was a win for banks. They were able to play with liquidity to sort of make up for some losses that they were suffering because of COVID, the pandemic, et cetera, right? And we know this may be expiring on March 31st. As of now, Jerome Powell, the Feds, have not spoke on whether they're going to extend this ruling or not. So I've pulled up the short, not the short sale rule, the supplementary leverage ratio. So the Federal Reserve does not extend the bank's supplemental leverage ratio exemptions. So we're just going to dig into the first little piece of this. Fed Reserve Board of Governors says it won't extend a temporary suspension of pandemic regulation due to expiration on Friday. Major U.S. banks will start next month on U.S. Treasuries and central bank deposits. On the other hand, we need to resume holding an additional layer of loss-absorbing capital this month. However, the Fed said it would begin a formal review of its capital rules, known as the supplementary leverage ratio, due to its concerns that it did not function as intended as a result of the central bank's emergency COVID-19 monetary policy measures. The Fed's decision to review the rules is a win for Wall Street banks, as this may allow them to decide to keep it. They may not. There's different ways this could play out. Who have long claimed that there is a fundamental flaw in leverage ratios, but as many analysts expected, it would extend the exemption. I was disappointed that I refused. So essentially, what this may end up doing, right? Wall Street banks lending out huge sums of money to hedge funds and institutional investors who are able to leverage these. My hypothesis, this is just my opinion, based on what I've seen happen in the market. We're going to dig into this more because of bond yields, right? So I've got other resources available to kind of back this up. There's huge shorts, unprecedented shorting taking place in the market. And honestly, I think the 10-year yields for bonds will represent that. So huge shorting taking place in the market. And we can see this with other stocks than just AMC. It affects AMC directly. And I think that's why you're seeing AMC have such a freaking hard time recovering from some of the massive shorting that's taking place. I mean, if you look at all of this, AMC, massive buying, can't make any moves, right? Insane leveraging of short positions. And if you were to look at Ortex on AMC, you can see that, in fact, you have a double down on the total shares on loan. 118 million shares on loan, which is a 103% increase from 7 days ago. Well, this must mean that there's extreme leveraging on short positions in stocks like AMC. I think about all the squeezes that happen across the market. There's a piss ton. It seems like every single day there's a new stock that has a short squeeze, right? I'll be live streaming and someone will be like, dude, check out this stock. It's going nuts. I'll look it up on Ortex. 100% utilization. It's got like a 300% borrow fee rate. Just stupid, ridiculous shorting going on in the market. Well, my hypothesis here is based on that information that we know, there is huge shorting taking place that's likely being taken advantage of because of the supplementary leverage ratio, which may expire on March 31st. We're going to dig into bond yields to back my statement up, right? So bond yields, what I believe, based on the information that's presented to us and this article, is that there is an insane amount of shorting, probably unprecedented shorting. And it's because of this. You've got a 4% repo right now. And what does this mean, right? So this likely means that there's a high amount of shorting. 3% fail charge. So what is a bond fail charge? It is 3% of a negative 3% yield, essentially, on bonds, which causes high tension. And you can equate this to essentially being like a hard to borrow stock, right? Because there's risk involved. A stock that's hard to borrow typically means that there's short borrow availability, but there's not very many shares available to short. And it also means there's going to be a high interest rate because there's a lot of risk involved with that short position. That means that there's risks involved with bonds right now. So when you drop below the 3%, we're going to talk about this as we read into this article, but it's supposed to act as a fail charge. Now, if we just pull this up really quick and we look at this, let's just dig into the meat and potatoes. Think of it as a borrow on a stock at some insane percentage, 100%, 1,000%, etc. It's similar in rates. Only such mechanics takes place in the repo market, and a rate of negative 3% is usually considered the equivalent of extremely hard to borrow. Even so, never have we encountered a 10-year trading so special it was below the fails charge. Now, what is a fails charge? We're going to dig into this here. Clearly, a significant amount of shorts rolled over, and now short demand has overwhelmed the available supply. There's low supply, extremely high demand for short positions. The issue traded as low as negative 4% today and already traded at 3.05 negative for tomorrow. Both of these rates are lower than the fail charge, which is the equivalent of negative 3%. Now, a fail charge, essentially what that's supposed to do is let me find the exact piece from this article. As I got to be honest with you, bonds are something that I'm new to. I'm still learning these as I go, but I want to give you guys solid information. So let me pause this and just find the exact piece in this article. Okay, so here we go. Why would anyone buy below the fail charge? So what the fail charge does, if you fail to deliver to a counterparty, there's a fail charge equal to 300 basis points below the lower bound of the Fed funds target range, the equivalent of a negative 3% repo rate. There are a variety of reasons why repo desk will cover a short below the fail charge rate, which include keeping clients happy, avoiding internal meetings and explanations, and internal rules that require shorts to be covered. None of this explains why the repo rate would drop to the mathematically improbable negative 4%, except to suggest that something is starting to crack in the repo market itself, which to me is insane shorting. So essentially what this is saying is, hey, this is a fail-safe. If it hits this negative 3% repo rate, they have the right, not the obligation, to cover a short below the fail charge rate. And they've got a plethora of different reasons to do so. Well, we've seen it drop to negative 4%. Granted, this article is older, right? This is back from March 4th, 2021, but still the ramifications are the same. And we see this reflecting on stock prices. And I would say the NASDAQ exchange pretty much, to a T. I mean, if you look back the beginning of March, this is what a lot of the uncertainty of the market started to begin, right? We had that sell-off. We had a little bit of consolidation, but still in a downward trend, right? You see this downward trend. We still haven't broken out of that uncertainty in the market, which I think is reflecting on this supplementary leveraging ratio coming from the Feds, as well as the bond yields, right? Heavy shorting taking place across the market. Right. So now that we've dug into that a little bit, I think what this comes down to, and it relates to that Federal Reserve on, is over leveraging. So think about bonds, think about the stock market, think about the housing market as a competition for liquidity, right? So if the market has, it's really selling off, you may see an opposite effect where the housing market starts to increase in value, right? You see more people start to put liquidity into real estate or bonds or what's supposed to be less volatile securities, right? So with that being said, the market versus bonds, it's fascinating to me that bonds are being so volatile as comparison to the market. That is atypical, right? You typically don't see, it's supposed to be a good equilibrium system, right? Market has a little more volatility, maybe more sell-offs, bond yields may change a little bit, vice versa, but you're seeing both markets and bonds have some crazy, unpredictable volatility and price action, which is reflecting probably my hypothesis on this Federal Reserve supplementary leveraging ratio. And this is where we come into this next piece, right? Tying these together, supplementary leverage ratio expiry, right? Will this solve the problem? If you don't know what SLR is, we did dig into it right here, but you can essentially think of this as banks are out of liquidity issues, right? So if a bank does not have a lot of liquidity, such as what happened with the pandemic, this allows the banks to sort of solve their liquidity issues, right? That you can leverage more liquidity to different people. It's been abused here a little bit, right? So now you may be seeing some margin calls beginning. I think they've already started, man. I really do. I think what happened here with Viacom, and this is just a hypothesis, right, is people see the uncertainty. They see, hey, the Feds haven't talked about this supplementary leveraging ratio yet, that SLR, and we don't know what's going to happen. So, hey, here's Goldman Sachs. He says, piss on you guys. I don't know what's going to happen, so I'm going to lock in my powder, man. I'm going to lock in my cash. You're not going to screw me by over leveraging. We are liquidating your account unless you provide the liquidity that you need. That big bank is going to lock in their cash, right? So they liquidated this Asia LLC that needed to pay up. That's what you see happen here with Viacom. And I think this is just the beginning. Now, how is this going to affect the market as a whole, and how would this affect AMC stock, right? Let's get into the conclusion here. So if you come to the conclusion is volatility. And I think you're going to see volatility in not just the meme stocks, but blue chip stocks, right? You look at this. You look at Viacom. This is some clean, steady, classic stair-stepping growth. Like, there is no reason to see this sort of sell-off. Look at this massive clean growth. I mean, you can't ask for anything better. That sell-off, that's not natural. You couldn't even predict that with technical analysis because there's nothing technical about that. This is a picture perfect, clean setup where you've got stair-stepping levels of support, which should act as a hold for situations like this, right? It dropped all the way down to $39.81. And I think you're going to see this take place with other stocks. And I think you've already begun to see it. I think Microsoft will take a hit. I think US-based technology companies will take a hit. I think Palantir will. I think Apple will. I think even Tesla may face some liquidity issues. I think there are some huge institutions out there who hold big stakes in companies like Tesla, and this could end up selling off. So if you're a short seller or you like playing puts, I think there's an opportunity within the next 1 to 2 weeks to plan a possible market correction. And I hate spreading fear, guys. I'm not that kind of guy, but I'm telling you right now, the NASDAQ is uncertain. This is uncertainty to a T, right? I always say that consolidation favors bulls, but it doesn't favor bulls in this situation because we had a sell-off. You don't want to follow a sell-off by consolidation because that is stair-stepping for a potential downward wedge, right? This shows weak buying pressure. This shows weak buying pressure and uncertainty. Uncertainty always favors bears, right? So this is not what I'm looking for. I really think you're going to see blue chip stocks and typically not volatile stocks, such as what you see here with Viacom, selling off. Now, how is that going to affect AMC? Right now, if you look at AMC, I think there's some really heavy short interest as we'd show you guys, right? The shorts that are currently being held in AMC has doubled, right? It's up 100% from 7 days ago. It's sitting at 118 million shares on loan, right? These may end up getting liquidated. They might, they may not. It's very hard to say, but I do think it's possible at the very least to see some of these shorts get liquidated or closed out, right? And if they're not, you're going to see it reflect in the rest of the stock market. The rest of the stock market is likely going to go freaking haywire. You may see some massive sell-offs, and I'm not trying to scare anybody. I'm just saying how it is, right? There's some legitimate worry here and how this could affect the stock market as a whole. So margin calls, shorts covering, I had already mentioned that. I think that is potentially going to affect AMC's price. I can't guarantee that for sure. It all depends on the banks. It all depends on the lenders, right? How much they ended up leveraging out. Are they going to liquidate all your positions? Do they need to make sure that you're not losing more? I mean, especially with a situation like AMC or GameStop, where you've got heavy short positions that's being really leveraged heavy short, the losses are infinite. And with all the eyes on this, the trader sentiment, the buying pressure, they could have some infinite losses, and that could be a catalyst that drives a short squeeze in the near term. Now, I personally believe that AMC is going to be more like a Tesla squeeze, where you see a repetition of shorts covering, doubling down on the top. It drives up after it runs down a little bit. They cover again. They double down at the top over and over, like you saw happen with Tesla, right? I think that's how AMC is going to play out. But in the short term, I think you could see a pretty nasty push within the next 1 to 2 weeks, especially if that SLR does not get renewed by the feds. This can lead to some massive squeezes. And I don't think it's going to just happen with AMC. I think AMC is just one of those stocks that is possible to see with, but I think there's other stocks out there, GameStop, COS, CAMPH. I think there's two pretty large new Chinese education stocks that are being pretty heavily shorted, EIQ and Waifu, that could face some massive squeezes. So what I would say is this: less leveraged shorting, right? At the very least, with this SLR gone, they may have to cover at least partially some of their short positions if they can't leverage the way that they have in the past. Some of these big hedge funds, some of these banks that are lending out extra, liquidity, essentially, they're going to be like, hey man, there's a huge risk involved for me. And at the very least, if I'm not going to, take that liquidity back, I'm going to drive up that short borrow fee rate, that percentage from that 3% you're looking at with AMC to 100%. Or 200%, or 300%, or whatever it may be. This could be a very legitimate catalyst. And I'm not kidding. This is a hypothesis, yes, but this is based off hard fact. I mean, this is really crazy stuff, guys, where this could drive some insane price action for AMC, could drive some insane volatility across the market. And guys, if I had any advice, it would be this. And of course, I'm not a financial advisor, but this is what I've already done personally, is this. My second portfolio, where I keep all my long-term growth stocks, my blue chip stocks, I have taken a little bit off the top. I took off about 20% from most of my long-term positions, so that when this ends up pulling back, because I think it's going to, I think you're going to see some pretty massive liquidity issues and massive sell-offs that have happened, similar to what happened with Viacom, right? And maybe not to that extent, but you get my point here. I pulled a little bit off the top, anticipating we may see a sell-off and some more uncertainty in the market, right? So that's one thing that I've said. Secondly, I would say that AMC very, very likely to have a massive run-up. So if you were going to sell, right, out of pressure, out of being scared, out of uncertainty, I don't think this is the time. Okay, there is risk involved, obviously, with AMC. Nothing is guaranteed about the stock market, but what I will say is this: I don't think now is the time to do it, especially knowing what we know right now regarding the Feds, regarding this SLR, scenario, and how this may end up playing out across the market. We've seen it in real life example. We've seen an example here with Viacom CBS. We've seen that massive sell-off. We saw it drop down to $48 from $101.97 at a peak, right? That's an example of what is happening and how much pressure we have on these short positions that are over leveraged, likely creating synthetic shares, likely playing with more money than they can afford to lose. It's free for us to hold. It's free for us to hold. It costs them an arm and a leg. And you can see the damage. You can see the damage that it did to some of these hedge funds. So that's what I've got for you guys today. That was a long video. That took a long time to prepare. I got to be honest with you. I was not very familiar with bond yields. I've very briefly done some research on them. And if I mess any part of that up, I apologize ahead of time. That's not my strong suit. But I wanted to get at least a basic understanding of what's happening here between the Feds and the bond yields that shows that there is actual pressure and actual uncertainty in what is going to happen here for these hedge funds. If I was a hedge fund right now, if I was a bank, I'd be saying pay up, because this is getting really, really risky right now. If I was a hedge fund, I'd be shitting my pants. So that is what I've got for you guys today. If you enjoyed the video, please drop a like. It really does help support the channel, and consider subscribing if you'd like to see more content like this. Lastly, I'm going to fill link in the description box down below for Webull. This is version 4 for the desktop. Great platform that allows you to start trading at 4 a.m. in the pre-market. If you use my link, you get 2 free stocks with the $100 deposit. I'll receive a free stock. Great to support the channel, my friends. And if you're not interested, that is totally fine. I just appreciate your support by taking the time to watch my videos. I also have a link to the merch store in the description box if you want to check that out. We've got a whole bunch of cool stuff, some mugs, some t-shirts, some hoodies, stickers, the whole 9 yards. If you want to check that out, feel free to do so. And a link to my own personal Discord if you want to check that out. It's full of a great community of investors, very intelligent people. We talk about long-term stocks, short-term stocks, mid-term stocks, tax season, AMC chat room. We've got a whole plethora of really, really cool stuff here. So if you want to check any of this out, feel free to do so. It is all available for you there. And that is what I've got for you guys today. Thank you for tuning in, my friends. I'll catch you all in the next video, and peace.